This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this StockBox interview.
Joining us today is Alexander Scanlon, the CEO of Barton Gold. Alex, it's good to be speaking to you again. It's been quite a while. I think it was back at the start of the summer. How are things?
Going very well. Thank you for having me back.
No, it's good. Always good to be catching up. So, I mean, a lot has happened. I was looking through the press releases there. There's quite a lot. I've picked out a few that are highlighting, but maybe from your point of view, first of all, just give us some of the key highlights over the last 100 days or so.
Yeah, definitely. Look, I sat down and tried to list out exactly what's happened in that time because it's been a pretty busy period of time. In a manner of speaking, we've essentially crystallized a lot of the things that we've been working on for the past few years. But I guess to take them in order of sort of development and priority, our stage one project at the Central Gawler Mill, we have done 2 resource upgrades to take that up to about 313,000 ounces adjacent to the plant there. We have published a preliminary study showing that the plant can be fully reinstated back to its 600,000 ton per annum capacity for about 26 million Australian dollars, so about 15 million US, very, very cheap. And we have announced last week that we've started the definitive feasibility study now to fully map that out in a 2-phase process for phase 1 high-grade tailings, phase 2 the addition of high-grade material, targeting commissioning by the end of 2026. Moving down to the Tunkillia project, we have actually started the resource upgrade drilling for reserve conversion. So we have expedited that project. We are looking to convert all of the resources, the in-pit resources to ore reserves, complete a pre-feasibility study and a mining lease application also all by the end of 2026. The Tolmer high-grade gold and silver discoveries, we've undertaken multiple rounds of soil sampling. We had several drilling results that extended the high-grade gold and silver there. The soil assays then confirmed an further expanded footprint of this sort of gold, lead, silver mineralization, and we did diamond drilling to work out the structural orientation. So those results are pending. We also acquired another project. So this is the Liquidity Gold project. It's a 280,000 ounce asset to the south of the future Tunkillia plant. We got new tenements granted there, and we also published test work showing that that is 97 to 99% gold recoveries and the ability to produce high-grade concentrates to go to our mill. And then kind of on the top of this at the corporate level, we have had a very strong continued share price performance. We've actually now become a member of Australia's version of the S&P 500. So that's the All Ordinaries Index. And we are actually halting the markets tomorrow morning. We have big news that we've gone straight to sort of the blue chip of corporate endorsements, and Franklin Templeton is going to become a significant investor in Barton Gold next week. So very exciting way for us to mark the next stage of the next era of our journey.
Well, that is the big news, isn't it, of course, about Franklin Templeton there. So that's 15 million Australian dollars. I mean, what do you think's driven them to invest? Have they been looking for a while? Is it the last few months that have really driven them to make that decision?
Yeah, so as you mentioned, we're looking at around a $15 million placement. They're leading it. We're actually making some room for a few other groups who've been seeking to participate for some time to come in. As you know, we don't actually issue very much equity, so we're sort of trying to fit everybody in there. But really, we've gotten to know Franklin Templeton over time. There is a close association between Franklin Templeton and Merck, which is one of our significant institutional shareholders. So, we've just kept them up to speed with what we're doing. Obviously, with the fact that we've grown to the point that we've grown, we have this infrastructure that we can leverage to near-term production, and we're sort of making that transitional step. It's really an ideal point and time for them to step in, and we are now also critically large enough in terms of market capitalization that we sort of actually fit into their mandate. So it's really a question of getting the stars aligned and waiting for the market capitalization and liquidity to catch up.
Okay, good. And for maybe, I'm sure Australian investors are aware of who these guys are, but maybe just tell other audience members who perhaps are not familiar with Franklin Templeton who they are, what they do, what do they invest in?
So Franklin Templeton, one, they're a very, very large institutional investor, but they run the Franklin Templeton Gold and Precious Metals Fund, which is one of the largest gold funds in the world. So they're sort of global top 10 fund. I think they have about 4 billion Australian dollars under management, about 2.5 billion in that gold fund.
Right. Okay. So yes, a good company, a good investor to have on the books there. So that money is obviously going to be put to good use. If we go back to sort of stage one and the Central Gawler Mill, and you increase that resource, as you said there, and you're going to be looking at reconfiguring that mill. So 26 million Australian dollars. So, I mean, first of all, how does that resource increase support the stage one production plans? And in terms of actually getting the mill reconfigured into production, what are we thinking here in terms of timeline and also funding that?
Well, there's sort of two elements that play together nicely between the resource and the mill itself, right? So one, we've demonstrated that the cost of reinstating that plant, if we just go back to a traditional hard rock 600,000 ton per annum operation, is not very significant, right? So 26, just call it, let's round it to 30 million Australian dollars for sake of simple numbers. You're talking about 20 million US dollars. So in terms of the capital drawbridge that we have to cross to go from pre-operations to operations, it's a very short drawbridge, so to speak. Okay. But we still, even though that's a very short step, we still think about what's the risk inherent to crossing that drawbridge? How do we de-risk that further? When we think about the resource that's there, we have about, of that 300,000 ounces, there's 200,000 ounces of high-grade fresh ore on the existing open pit and the existing underground development. So it's all pre-developed. So it's nice kind of like walk up, take it off the wall kind of stuff, which is very convenient to be sure. But starting a site operation and open pit and underground operations all at once is a much more complex exercise than, for example, starting your site and your mill and pushing those back. Now, how would you actually push those back if you need to feed the mill? Well, it happens that we have some high-grade tailings on site there next to the mill. And our tailings storage facility 1 is a facility that was being filled between 2002 and 2008 when the head grade going through the mill was between 5 and 10 grams per ton at lower gold prices. So the mill was kind of being force fed. And what it resulted in is sort of a higher grade outer ring of material that grades between 0.6 and 1 gram per ton gold. It's very clean metallurgy. It's essentially coarse material that was underground. So what we'll do is we'll mine down those high-grade shoulders of that tailings facility. And the first 12 months we'll be processing tails. And that is a much, much lower risk sort of cultural transition for the site. Then once you get the mill running and everything's going smoothly, once the site's running smoothly, then 12 months later, you turn on the hard rock and you start blending that in. Okay. So you sort of ease into it, and that also allows you to defer some of the capital cost associated with the crushing and grinding circuit.
Absolutely. And have you any idea at this stage what the tailings could generate for you, monetary wise?
Well, look, I mean, that is very much the purpose of the definitive feasibility study. But I think, if we had to, kind of go to, philosophy here, right? If we put, 800,000 to 1 million tons of those tails through the facility, and then we can recover 70 to 80% of that gold, we might be able to produce, say, 17.5 to 20,000 ounces right in the first year of production before you're adding in the high grade. Now, higher grade equals more ounces, equals less dollar cost per ton for the number of tons being processed. So we would expect this lower number of ounces to come with a higher dollar cost. But, the current gold price has just crossed over 6,000 Australian dollars. Yeah. I would be pretty surprised if we weren't able to earn $3,000 per ounce profit. So now we're talking about $50 to $60 million in operating free cash from the first year. And then when you start blending in the fresh ore, now this ore is 3, 4, 5 gram per ton. Now you're taking your average feed grade up to 2.5, maybe 3 gram per ton. And the effect of that is you're not producing 20,000 ounces, you're producing 40 or 45,000 ounces. So again, we should see the cost per ounce going down as the ounces are going up, and we would hope to be producing, if we're producing 40,000 ounces, we would hope to be producing $120 to $150 million per annum in gross free cash flow. And then that's kind of our steady state production at the mill there while we're getting Tunkillia ready for development, and then it funds that development.
Excellent. It sounds very, very good. Just sticking with this stage one at the moment, because that's the most imminent. So the DFS that's on track for H1 next year. So when would you be looking? I mean, well, first of all, is that still on track? And at what point do you think you'll be able to sort of actually start getting into operations there?
So we are looking to complete the DFS by the end of March 2026. And the objective is to actually commission the mill by the end of calendar year 2026.
Okay. So
in a matter of speaking, we kind of want to be able to deliver a holiday present to everyone and say, great, the mill is spinning. And on, from the 1st of January, we are into our, 2027 becomes our first full production year.
Brilliant. Okay. Excellent. Good stuff. Well, that's nice to hear on stage one. Of course, stage two, Tunkillia, you've been working on that resource upgrade drilling. I think 18-kilometre drilling program at the starter pits you began in September there to upgrade that resource from inferred to indicated. I mean, the gold price, as you mentioned, has done incredibly well. It's unbelievable. Every day it goes up. I think you had an original projected free cash flow over 12 to 13 months of 825 million Aussie, but now with gold, at US 4,000, that's far above your 2,500 Aussie per ounce assumptions. Could we expect to see you accelerating the development timeline here, or project financing?
Yeah, so we actually have accelerated. So we actually started all of the long lead environmental work. So flora, fauna, water monitoring. We'll be starting additional water bore drilling. The drilling that we've actually started right now, it's 18,000 meters of a total approximately 50,000 meter program, but that is specifically targeting the upgrade of that sort of stage one and stage two starter pit, or the starting pits, the first two stages. The reason why we are doing that, one is that's all going to be converted to indicated, and then the actual central highest grade zone, which is where you get that 1 year payback, that's actually going to be upgraded and measured. So that will be able to be converted to proven reserves. The reason for doing that is it's not necessarily necessary, very redundant, but it's not necessary to convert to a reserve, because you can get a probable reserve with indicated resources. But what it does do is it will increase the density of drilling points we have in this higher grade zone. It'll increase the geostatistics there. It'll give us greater confidence about the conversion of all of the other in-pit mineralization into indicated and eventually measured as we go to grade control drilling. But it'll essentially very firmly underwrite accelerated financing conversations, which very much to your point. We have already been approached by and started having conversations with large-scale corporate financiers. We are looking at what is the optimal pathway forward for Tunkillia. As you know, we take a portfolio approach in terms of our assets. But suffice to say, a payback profile, the first year produces around 200,000 ounces. If the grade is confirmed, that may confirm there's actually more in there. And at the current gold price, we constrained the original pit design at 3,500 Australian. Our revenue assumptions were based on $5,000 Australian. At $5,000 Australian, that pit would produce, that stage one pit would produce about 850 million Australian dollars in the first year. At the current gold price, it would produce about 1.25 billion in the first year. So it essentially, if we turn that on today, you'd put $400 million into the development and you get paid back 3 times over in the first 12 months. So from a credit financier standpoint, now a bank wants to have their money lent as long as they can, but they want to know they can get paid back instantly if they need to. Yeah. So it's very much the ideal lending profile for the types of institutions that we're talking to.
Absolutely, absolutely. It sounds very positive. And it's 2.2 million ounces gold at the moment and 3.1 million ounces silver, but you're expecting that to increase, are you?
Well, so the 2.2 million ounces we have are across, our Challenger project, The Wadena project, which we just acquired, is about 300,000 as well. And then Tunkillia is 1.6 million. Now, all three of these projects do have growth potential. We've actually been focused in a pretty small area of our land package, essentially crystallizing the base of these projects. Yeah. Now that we have that base established, and what we're talking about now is a 15-year pathway of production and growth from 0 up to 150,000 ounces per annum across that timeline. Okay. We've got 15 years of development and production ahead of us now. So now we're starting to look out at our sort of regional enhancement projects, Tarcoola, Tolmer, high-grade discovery, the Wadena project, and we'll also start looking along the structures that host these ounces, because obviously the best and most likely place to make a new discovery of a major body of mineralization is in the vicinity of the existing one. And these are really pronounced structures. So we'll now work on essentially, we've created the platform. Our regional blending assets allow us to average up our feed grade. And now we'll work on extending that platform further.
Okay. And then, so Tolmer, then that's really where the silver, silver lead zinc comes in. And Wadena's the recent acquisition, a gold project. Do they just fit into the bigger picture, or could they become sort of a standalone open pit, low cost operation?
Well, I mean, they will, unless we can find a way to somehow migrate the material underground, they will be their own standalone pit, right? But I think the idea here is, if you have infrastructure that you can leverage, the best thing you can do is then leverage that infrastructure further, right? So with an existing mill, rather than building another mill next to it, in really simple terms, you'd rather amplify the grade going through the existing mill, right? And so the idea is we'll have our existing plant at Challenger, we'll have our new plant at Tunkillia, and then Tolmer and Wadena act as satellite blending feed of high-grade materials.
Okay.
So it's sort of like supercharging an existing high-performing engine, if that makes sense.
Yeah. Okay. Absolutely. And then finally, then that you're getting on the S&P, effectively the ASX All Ordinaries Index. So that's really helping with liquidity. Is it here and sort of raising money amongst the Australian investors?
Yeah, I mean, it's certainly interesting to see what happens or what has happened with liquidity. We already had very strong liquidity for a company of our size. So when we were a $150 or $200 million business, we would trade on average about $500,000 a day, which relative to our free float and capital outstanding is a very high proportion of trade. It's more like a $500 million business. Now that we're on the All Ordinaries, what we have seen is essentially a normalization and steady increase of that volume. Okay. So now we're kind of trading, I did the numbers recently, about $900,000 worth of shares a day. And so now we're starting to trade like a company that's sort of over $500 million in market capitalization. Okay. The point to that really is that it's always good if you can continue to enhance your liquidity kind of ahead of your market cap. Because what it means is that you're a safer space for the types of investors who are then going to take you in to that type of a market cap. So now we are now we're inside the mandate, so to speak, for a lot of the on-screen traders who are maybe not specialist funds, but they want to get involved in the story. They want exposure, but they want to know that they can move into their position and move out of their position without pushing the market in either direction.
Absolutely. Good. Just a final question, Alexander. We've got plenty of cash now. You've got to allocate that. You've got to look after it. I guess you're going to be doing that. You seem to have done it fairly good track record so far. But just in terms of capital allocation and prudent spending, what can you let shareholders know?
Oh, look, yeah, we do manage our capital quite carefully. So we'll squeeze every basis point out of that while it's sitting in our accounts. But in terms of where we're going to spend it, again, the size of the prize for us in terms of corporate evolution and valuation to moving from pre-production to production cheaply is very significant. So we're obviously going to be investing that capital in a very high quality definitive feasibility study focused on a de-risk pathway. That will also support the full conversion of resources to reserves at Tunkillia, a pre-feasibility, a mining lease application. So really, I think the idea is with our demonstrated ability to use capital quite well, we are in a very, very good position to complete that next evolution in Barton Gold's journey. It's in fact, we have now have more capital than we have ever had, and we've done a lot more with a lot less already. So that's pretty exciting for us.
Good. And I wonder if I can just get your thoughts to finish off on the environment. I know you've been doing the rounds, you've been at Beaver Creek, you've been travelling around quite a lot. Of course, we met at the Swiss Mining Institute back in March. I'll hopefully be there again in November. And I don't know if you caught the panel discussion with Willem Middelkoop and Florian Grummers, but they were talking about the gold price, and Willem called it to 5,000 in 18 months' time, and Florian ran the technicals. And I mean, it happened almost exactly as he said. I remember he said a pullback to 2,900 is a buy, and I didn't. I waited a week, and well, it lasted about only a week. But what is your sense of the gold price? Do you see it just continuing? What are you picking up any other bits of information from your travels recently, and what people are thinking?
Yeah, look, I mean, I think a lot of people are asking exactly this question, right? Because typically when you see something repriced this quickly,
yeah,
the natural fear is that it may be moving too quickly, it may be overdone. I sort of take a longer term. I'm probably more in the Willem Middelkoop camp of how I look at these things, and you know, the decision to essentially buy an entire gold district started in 2016 when I was doing macro analysis and deciding where we wanted to build exposure as a family office, and as a family office manager, I should say. Look, what we are seeing right now is just the beginning of the unwinding of a 50-year compression and demonetization of gold. So if you consider that post 1971, everybody was moving out of gold into dollars and oil as a reserve asset. It took 50 years to compress gold to its sort of central point of meaninglessness that people saw it at a couple of years ago. The problem is that those people who've now successfully mounted a challenge to US dollar hegemony, led principally by China as the currency issuer and Russia as the world's largest energy producer, they started buying gold hand over fist in 2014, and we picked up on that, and we started looking at the macro. And so we started buying gold hand over fist in 2016 and 2017. It is only now, and really since the conflict between Russia and Ukraine, and the Biden administration's decision to sanction Russia's treasuries, that essentially the straw broke the camel's back. The U.S. dollar is no longer, U.S. treasuries are no longer seen as a safe reserve asset. And only for the past 2 to 2.5 years have we started to see the beginning of the unwinding of the compression of gold as a monetary instrument. We have to unwind 50 years of compression in the next 5 to 10. That's exciting. But consider, what are we unwinding? What we're unwinding is the monetization of debt, or put another way, we're remonetizing gold, and the amount of money that has been printed since gold was demonetized is a large, double digits multiple of the amount of money that existed at that time. So when you consider, the real question is how far does gold remonetize? Because the quantum of capital in nominal terms that has to find its way back into gold to get back to some kind of level is a large multiple of the quantum of capital that got squeezed out of it. So it's really hard to predict where we go, but it does lead me to start to think about the question of how much printed currency is out there relative to gold to store it in as a more likely predictor of gold's revaluation than simple supply and demand characteristics, right? But I tend to hold the view that I agreed with Willem when he took that line. I tend to hold the view that I would be, at least in the next 3 years, very surprised if we didn't see 5,000 US dollar gold. In the next 10 years, I would be very surprised if we didn't see $7,000 to $8,000 gold, and I'm honestly not sure beyond there. But what we're watching is, and I think more people are finally acknowledging this. This is a structural realignment of a unipolar monetary paradigm that is now a multipolar paradigm.
Okay.
And there's a lot of interesting things going on. That's a very long conversation for another day, so I'll stop economizing for you.
Yeah, we can do a podcast on that at some point, maybe. But yeah, really good to get your points on that. But thank you very much for your time, Alexander Scanlon, the CEO of Barton Gold.
No, thank you.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.